Hello, everybody. Thanks for joining today's webinar with Horizons ETFs on investing in disruption. Sorry, we started just a couple minutes late. We wanted to allow everyone time to, all the people to register to sign on and participate in today's webinar. So first, my name is Jeff Lusick. I'm the head of the retail sales team at Horizons ETFs, and I'm joined by Mark Noble, who's the head ETF strategist with Horizons ETFs, and we're going to talk about the opportunity of investing in disruption and utilizing some of Horizons ETFs to help you do so. But before we get started, I'd like to go over a few items so you know how to participate in today's event. When you join today's webinar, you selected to join either by phone or computer audio. So if for any reason you'd like to change your selection, you can do so by accessing your audio pane in the control panel on the upper right-hand corner of your screen. You will have the opportunity to submit questions to today's presenters by typing your questions into the question pane of the control panel. And you may send in your questions at any time, and we're going to collect these and address them during the Q&A session at the end of today's presentation. So today's presentation should be about 45 minutes, allowing us 10 to 15 minutes of time for questions, and we'll try to have everything completed within the hour. So just so you are aware, there are handouts or PDFs that you're able to view during this presentation. So the presentation itself, the Horizons product lineup, and product sheets for RBOT, blockchain, and our mined ETFs are available to download in the handout pane of your control panel. So you can download these at any time during the presentation. So please also note that this call is recorded, so you're free to listen to the content following the live stream call, and we will be sending out a replay of this webinar. But I wanted to start with why we're focusing on this topic today. What we have found is that a lot of our clients and investors, a lot of them are professionals and business owners, and that they're seeing this true disruption on a day-to-day basis, and it's real for them. So, but what many aren't able to do, or what they are not doing yet, is they're not investing in it yet. Artificial intelligence, robotics, and blockchain companies do have very little overlap with major stock market indices, given that they're relatively new industries and companies spread throughout the world. So if you're invested in more of the traditional indices, you're not accessing a lot of these names. So we're able to provide that opportunity for you, as we have committed ourselves to offering a number of our key ETF solutions designed to give investors diversified and liquid exposure to companies that are crucial to building this Industry 4.0 or investing in disruption that we're going to talk about. So at this point, I'm going to pass it over to Mark Noble, and he's going to talk about some of these opportunities. I'm going to ask him some questions throughout the webinar, and if there's additional questions at the end, we're going to have that opportunity for you to ask those questions. Mark?
Perfect. Thanks, Jeff. And guys, this is a really interesting topic right here. I think congratulations on being in this webinar and embracing this right now, because I get excited because I think right now we are on the precipice of one of a unique generational investment opportunity, which is the ability to invest in what I call Industry 4.0. Now, you hear a lot of talk about Industry 4.0, and one of my goals here today is sort of demystify jargon like Industry 4.0 and make it interesting and relevant for you. So I'm not going to try to talk too much like a grade 12 history teacher, but it is important to kind of go back about 300 years to understand just the role that technology plays in investing in economic disruption. So I have a picture here of 4 major changes in the global economic development of the world, and they're all based on technology. I think we tend to discount just how important technology is in terms of leaping us forward from an economic and social development. So if we go back to 1784, most of the world was agrarian in agriculture. Probably, if we were to try to crunch the numbers, we're probably looking at about 99% of the population in some sort of rural agricultural setting. And something happened that was really profound in the late 18th century, which was the development of mechanization and steam power. Now, looking back now, it doesn't seem like a big deal, but at the time, what this allowed for was really the specialization of labor. And this is something that never existed in human history until this point. And it changed everything, and it started what we called the Industrial Revolution. It started the idea that people could do more than farm and, do more than the military, do more than just be landed gentry. You started to get factories, you started to get steamboats, you started to get travel, and you got industry. And in fact, anyone who lived between sort of the most of the 19th century saw the most amount of disruption in human history from this transition as people started to move away from the countryside into the burgeoning cities and started working industry. And if you look at the economic history of places like the United States, for example, it's built on things like the textile industry and the weaving loom as the major cornerstone of its economy for most of the early part of the 19th century, which culminated in the Civil War. Now, we're not going to belabor too much, again, the facts of history, but then we move to another cycle, almost 100-year cycle of Industry 2.0, which was was started by this amazing invention called electricity. And what did electricity do? Well, electricity really allowed us to automate things. It started to make it possible that industry could be powered by something other than humans and could be done with a renewable and always going source of electricity. Factories could run 24/7. And as we move forward on this industry post-war period, obviously we had a couple world wars in this period, but as we move to the post-war period, we started to really see the culmination of Industry 2.0 with the rise of the Henry Ford or Taylorism manufacturing, the rise of the middle class. And let's understand that the middle class rose about from this development of Industry 2.0, and we were able to, again, leap forward in terms of industrial production and output. And then we moved to the late 1960s, early 1970s, and we have another technological disruption. And that disruption was really the computer processor. And if we think about what has happened during Industry 3.0, we went from the development of the computer processor and then really leapt forward with the personal computer. And then we moved forward over the last 30 years in the creation of the internet and what I refer to as the digital world. And what we've been creating over the last 30 years has been the digital world, and that's had a massive impact on everything we do, but it's still a world apart from us, right? We can enter the digital world through the internet. We can obviously create more data today than we'll create in the rest of human history, but that digital world exists apart from us. So now we transition into Industry 4.0, and we're really on the precipice of a new 40, maybe 100-year cycle. And then this is where we're talking about simply merging the digital with the physical. So we created the digital world, similar to creating steam power in 1784, which allowed for mechanization. But now what we're doing is everything that's in our physical world can be disrupted by the integration of data and technology and robotics. And that's what we're talking about today, this new economic trend, and of course, really powerful ways to invest in it.
Right, Mark, and that's what I just wanted you to touch on a little bit more is the difference between that 4.0 and 3.0. And a lot of people still believe 4.0 is just the internet. So how is that really being utilized with the data to bring it to the physical?
Well, and if we think about Industry 3.0, we're talking about really the creation of the PC, computer, and then the original software companies like IBM and Microsoft and Cisco Systems, Sun Life Microsystems, where we built the infrastructure for the data. And now we're sort of seeing the power users, the companies that have really embraced the data revolution and taken advantage of that. And guess what those are? Those are the big FANG stuff. Facebook, Apple, Netflix, Google. These are companies that have embraced the ability of using data to improve our lives. What we're talking about now today with Industry 4.0, and it's a great question, Jeff, is disrupting everything else. I mean, we're disrupting fridges, tables, jackets, self-driving cars, drones. This is a new era, right? And these are not necessarily internet-related things. These are things that would be connected to the data world, but they would be household items and day-to-day things that we do that are disrupted by this technology.
So utilizing the digital and the data to then help the physical.
And what's happened is we have Moore's Law. A lot of people are familiar with Moore's Law. But when they see Moore's Law, that they see that the cost of microprocessors has decreased to such a level that I can now put those in almost anything, right? So you create that what we call smart products, and that's really what we're talking about with this Industry 4.0. Now, as you can appreciate, this is a huge opportunity. When we start talking about disrupting everything else outside the digital world, we're talking about a massive opportunity. And so by 2025, we expect that the robotics sector alone is probably going to be about a $1.2 trillion market capitalization. It's about $80 billion right now. And the other really important thing to understand, though, is this isn't just a trend that's going to disrupt the Western world. This is a trend that's happening everywhere in the world. This is a global trend being embraced by all regions of the world, in particular Asia and North America. And we're probably going to see this contribute to nearly 14% global GDP growth in less than 15 years. Now, that's astounding, right? That's an astounding amount of growth. And if we look on the next slide here, we can see that really what happens is this growth comes from 4 key areas. So the number one area that we obviously see is labor productivity. If we start using robotics and artificial intelligence, well, it allows for 24/7 usage of things like factories, farming, healthcare, but it also, improves the amount of the labor force, the efficiency of the labor force. So you just see more output occurring. We've already seen this occur in the last decade. I've seen stats suggesting that about 20% of the industrial output of the world has increased over the last 10 years, but we haven't really seen a lot of new jobs, right? That's from this empowerment of robotics and automation. The other big one is obviously personalization. So if we look at personalization, we're talking about the use of data. Now, if you think of things like, Amazon.com or Amazon.ca, if you go and you buy some sort of item on Amazon.ca, maybe you're buying a purse for your wife or you're looking at a new drill. Well, what happens? You get followed around for weeks with not only ads for that drill if you didn't buy it, but also similar sort of tools, right? Your vendors and the people you deal with online now, they know so much more about you from your browsing habits. They probably know more about your intuitive shopping habits than you even think you do. Now, that can be a little bit scary, but it also creates a much better customer experience in terms of creating items that are more catered to your needs. And then the final really big one is quality. We see this particular in healthcare, using artificial intelligence to just do a better job of diagnosis and contextual analysis of problem solving. We move to the next one.
Mark, just quickly on that topic. I know when we talk about this opportunity, a lot of people are bringing up an ethical issue or concern, and they're with the assumption that this is going to replace a lot of jobs, or a lot of people are going to lose jobs as a result of this. What's your thoughts on that?
Well, we're talking about, the presentation is called disruption. I think you need to understand that something happens with disruption, we're talking about change. And with change, there are winners and losers. And unfortunately, this does create some dislocation of jobs, particularly jobs that are very manual or quantitative in nature. If you're dealing with numbers all day, you need to be concerned about AI probably coming in and taking that away from you. But we also know what it does is it creates a whole new class of jobs, right, that are related to AI analysis, more electricians dealing with battery power, things like that. And then the more important part actually is what we tend to see is that AI doesn't necessarily come in and replace people, but actually increases their job efficiency. So the example that I like to use a lot is I was reading an article recently about last year, JP Morgan, for example, on investment banking brought in an AI system that could do about 35,000 hours of associate work in a matter of minutes. Now, that didn't result in them firing associates. What it did was it actually dramatically improved the amount of deal flow that they can look at very quickly. Right? So what ends up happening is somebody using AI just becomes much better at their job because a lot of the time they spend on these smaller, time-intensive things gets done by the AI, and then they can focus on the strategic aspect. So I look at more of it as an empowerment, not necessarily dislocation, but certainly with disruption, we see opportunities and we do see losers come in.
Thank you.
Now, if we look on 5 here, very quickly what I want to talk about on this is if we go back to the 1970s and 1980s, I want people to conceptualize again that we're in the middle of the early stages of that Industry 3.0. So in the 1970s, we have Ronald Wayne selling his 10% stake in Apple for $800, which would be worth about $100 billion today. And we have Bill Gates telling everybody at Microsoft that $600,000 for their shares of Microsoft should be enough for anyone to live comfortably on, right? Well, what was happening at this time? We were building the infrastructure of Industry 3.0, right? These things don't just happen overnight. They take decades to build. And so if I was to look at where the real opportunity set was in the 80s and 90s, it was in buying those early Microsoft, Sun Microsystems. Cisco at one point in time at 2000 was the largest company in the world. They were building the internet. They were building this world. We needed the picks and shovels to build that, and that's where the opportunity was. What was really interesting was if I was in 1998 trying to determine whether to buy Pets.com or Amazon.com was a real question that people had. Right now, we laugh at that right now. In fact, Amazon.com bought Pets.com not too long after that and suffered a huge loss. But you have to remember that Amazon.com really didn't move much between 1999 and 2012. That was a stock that people recognized the potential, but it didn't move because it was a user of the internet, not a builder of the internet. But then all of a sudden, once all this infrastructure is built, you have these power user companies, and they really take advantage of it. And so that's where we saw that opportunity set. But now we move to where we are in Industry 4.0. Well, again, where do I want to be invested? Well, I want to be invested in the companies that are building this industry. These are the companies that are building sensors. These are the companies that are building artificial intelligence. These are companies that are building robots, actuation, or companies that are integrating them. And they're not necessarily well-known companies, but they're building they're the picks and shovels building this infrastructure, allowing for investors to invest in this early stage but extremely important stage of this change.
So in today's example, or in today's time, what type of companies are the builders of Industry 4.0 and which ones are the users right now?
Right. Well, right now we don't really know what the users are, right? Because we're just building that infrastructure. I don't know, who the next great AI company is that's really going to take advantage of that technology. And in fact, maybe companies like Google and Amazon, they're already integrating this technology. But what I do know is that as people start to look at Industry 4.0 and want to compete in this area, they're going to have to be looking at these companies that provide them these hardware and base-up solutions. So they're looking, again, as I said, the sensor companies, right? If I'm building robots and AI, they need to be able to see and hear and interact with us. Well, you need sensors. They don't have eyes, right, and ears. If they're going to be building or putting for e-commerce things in boxes, they're going to need arms, actuation. So these are the kind of companies that we're looking at. And it's driven, by some really important demographic changes. Actually, the most important driver of this growth is aging population. And one of the biggest drivers of growth in this whole Industry 4.0 is in East Asia. If you go to places like Korea and Japan, where you have massive aging populations, Japan's sitting on a huge demographic issue of a massive declining population. In order for them to maintain competitiveness with the rest of the world, they're betting heavily on artificial intelligence and robotics to keep them competitive, because they're simply not going to have the bodies there available to make them competitive, even with things like immigration. So Asia, for example, has really doubled down. If you look at the per capita investment of places like China, Korea, Taiwan, and Japan relative to the West in this, it's absolutely astounding. We're talking hundreds of billions of dollars of investment in this area, because this is really where they see them keeping a competitive advantage. China in particular learned some hard lessons over the last few decades that size and numbers from a labor perspective isn't necessarily going to win you the day in the economic arms race. What wins the day is industrial output, intellectual capital. They're hoping that this sort of thing comes about. The other really nice thing is it actually improves the longevity of workers. So I'm going to talk a little bit later about things like surgeons, for example, who can work longer working in conjunction. Remember, again, empowerment working with robotics. Labor costs, I don't need to belabor this too much, but obviously, when you run 24/7, you can do more, which reduces your labor costs. The other really interesting thing that we don't highlight with robotics is, I know when a robot is broken. When a robot is broken, it's abundantly clear. Maybe it sparks, maybe it starts putting out data errors. Someone comes in and fixes it. With a human employment, unfortunately, we're not always at 80 or 90% efficiency, right? You come in on a Monday morning, it maybe takes you 3 hours to really get going, and on Friday, maybe you're gone by 2 p.m., right? That's just the nature of humans, and really what you can do is you can do a lot more consistency in terms of industrial output with labor costs. And then the last one, the really important one for me, is performance improvement. And I'm going to really hammer this home today, in that when we look at things like artificial intelligence, we're really starting to see something where the ability of AI in particular to improve certain things we do is dramatic, and it's astounding. And we do have to recognize at some point that machines and artificial intelligence and machine learning have the ability to simply do things better than a human can. So what are the sectors that are being disrupted? Well, the big ones that I've highlighted are transportation, agriculture, manufacturing, defense, and healthcare. And thanks to my friends at Global X, who run the largest artificial intelligence and robotics ETF in the world, they put this together. But I think it really hammers home what we're sort of looking at when we look at, where are the things that could be disrupted. Interesting that a study accounts for the fact that 15% of passenger vehicles sold worldwide could be self-driving cars by 2030, right? Less than 12 years from now.
Yeah, Mark, that's a surprising number. I mean, we're in 2018 now.
Yeah.
And in 12 years, 15% of passenger vehicles should be self-driving?
Yeah, well,
could be.
And you know what, Jeff, what's even more astounding is that this isn't a technological challenge, this is a human challenge. And by that I mean that the technology already exists for self-driving cars to be on the road. I mean, if you were to look at what happens with the annual DARPA challenge where they drive these self-driving cars and all the testing that's being done by companies like Uber, Tesla, Google's Waymo, they're already there.
Mm-hmm.
I mean, the challenge is really governments and people being comfortable with the idea of driving alongside, cars where someone could be sitting in a car reading a book or a smartphone while the car drives them. But if you own a Tesla or have a friend that owns a Tesla, the Tesla actually already has built into it the ability for self-driving. It's actually a firmware update, and if regulation allows for it in the state or province where that car is, it can be flipped to be self-driving. Okay, so the technology is there. It's a case of actually getting society on board, and that will probably, take a while, just like smartphones, took a while for adoption, and then we see it becoming almost a necessity or acceptance, right? Similar to light bulbs, I'm sure, in the 1880s being a bit more of a disruptor. Agriculture, we have a 5,000-year problem with farming where, the ability to farm during night has never been possible, which, if you think about it, reduces the amount of yield and productivity of crops. With the idea of smart farms, so these are farms using sensors, self-driving combines, we could see a massive amount of industrial yield coming out of the agricultural sector being forward by agricultural robots. And again, we're talking about possibly a $15 billion industry by 2020. I don't need to belabor manufacturing. Obviously, I think people intuitively understand what can happen with manufacturing and the idea of people working alongside robots, as well as logistics in factories. Defense, there's a big move on the military side to obviously decrease the amount of soldiers in combat. And, there's also ethical questions about obviously military conflict, but one thing we do need to recognize is that during the military conflict, in order to successfully achieve victory in a military conflict, requires infantrymen and women to be on the ground in war zones, which are extremely dangerous, result in loss of human life. The U.S. military has made it very clear that they want to start to reduce the amount of soldiers in the combat zones and replace them with things like drones and self-driving tanks to allow for occupation, but not necessarily the high level of death counts. A lot of investment going into drones in this area, and we have companies like out of Canada, even like Maxar Technologies, where they've really taken advantage of this military-industrial complex. And then the one that makes me feel good, and I think the one really where we're going to see massive changes in going forward is in healthcare, especially on the diagnostic side. We look here, for example, IBM's Watson supercomputer has a 90% diagnostic accuracy rate for lung cancer compared with the diagnostic accuracy rate for human physicians, right? This saves lives. So really, really powerful stuff. So here's the thing, right? And I think that, we talk about this, and I think people get that there's an opportunity here, similar to looking at the internet in early days. The problem is trying to aggregate and find all these stocks on one spot. If I look at any individual index, whether it's the NASDAQ, the S&P 500, or the MSCI World Index, the problem is very few of these are held in any one of these indices. They're dispersed across the globe, and even something like the MSCI World, they're relatively small overlap, probably less than 4% on any of these indices. So if you buy into this, you're looking to own it in one place, and that can be a little bit, tricky to figure out. So, you really want to be trying to own a lot of these companies, which are particularly in Asia, about 50% of them, and trying to find one solution. That becomes a challenge.
Right, and that's how I touched on at the start, that the average investor is not invested significantly in this opportunity.
We're going to talk about some of the names very shortly, but other than a few names, I would be very surprised if people on the webinar own most of these names, unless, of course, they own an artificial intelligence or robotics ETF. Now, I like to spend a little bit of time with artificial intelligence because of all the technologies, this is probably the one that has the most profound impact on where we're going in Industry 4.0. And it starts, I like to show with my story here, with a 40-year-old gaming system, the Atari 2600 from 1977, which I believe was a 128-bit RAM system, 8-bit graphics. I'm sure there's some people on the webinar today that had the pleasure of playing, Pong or Pac-Man on this system.
Frogger.
Yeah, listening to some REO Speedwagon or some Queen, right? But anyways, the point is that, not a very sophisticated system, obviously a lot of fun when it came out. So what does this have to do with AI? Well, Google in 2014 bought a company called DeepMind, and they paid about $600 million for this company. And it was a artificial intelligence incubator. And this company was effectively, people wanted to know what was it doing for Google. And so Google, at one of those sort of Silicon Valley events, although I believe this event was outside of Vegas, rolled out the Atari 2600. And of course, people started asking themselves, what exactly are they doing? Are they building a video game system? You have to also remember that by 2014, we're almost 20 years past the idea that, computers and machines could beat humans at a complex task, right? The most famous being the 3 out of 4 games that IBM's Deep Blue beat Gary Kasparov at chess. So the idea that you could, do something with a video game system or a machine wasn't all that interesting. Anyways, if you look forward, what happened was they put up a game called Breakout, and it basically showed a simulation of this AI playing Breakout. And the AI system initially playing the Breakout actually was losing a lot. But after 30, 40 games, it starts to win. And after 200-300 games, it starts to do things that sort of defy the physics of what could actually be done with this technology when it was developed. And so where the aha moment here, where I'm trying to get at here, was that unlike the Gary Kasparov situation where a computer was programmed to beat him at chess, so it was taught to play chess, it was taught all the statistical parameters of each move on the board and then could remember them. This AI had never seen this video game before. So similar to you and I going in 1977 or 1982 and playing, Space Invaders or Breakout at an arcade, we had to figure out how to play this game. And so the aha moment is this AI had never seen the game, it taught itself how to play the game, and then it taught itself how to beat the game.
Self-learning along the way.
Self-learning, and we call this, if we move to the next slide, we call this machine learning or deep learning. And that's what we're talking about when we're talking about AI, is we're talking about this work forward in machine learning that uses these deep learning. Now, I'm not going to get into the technology behind this. I'm sure there's some people on the call that have a lot of expertise in this area. But the point is that basically what happened is the idea behind deep learning has been around for a long time. It's the idea of basically using human learning process, a layered approach that the brain uses, but digitizing it and using massive amounts of data to do that. But it really wasn't only possible to this last decade because of a work forward in processing speed as well as data, right? Now where there's the data, your brain's only as good as what you've learned. There's the data now to analyze things that allow for this deep learning to go forward. But now we can use this deep learning system for a whole myriad of things on a go-for basis. And so, the way deep learning learns is actually a fairly simple process. And again, I equate it to how a human learns, but it has some very key differences. So if we look at, one of the initial challenges that people look at with AI is they usually ask themselves the question, is an AI looking at the difference between what is a cat and what is a dog? Now, this would seem very intuitive, obviously, to us, but it's not when you first meet a cat or a dog. If you first meet a cat as a toddler, you have no idea what that is. Maybe you pulled its whiskers, got whacked in the face. I don't know, but the point is that it takes a number of times for you to see pictures of cats and dogs before you start to realize that there's some very intrinsic differences there. Well, it's the same thing with an AI, except the difference between AI and you and I is that when I put 10,000 cat pictures and 10,000 dog pictures in front of an AI, it can use all of those as a reference point immediately. So it looks at a picture of a cat or dog, and then it references it against the other 10,000 pictures that it's seen. Now imagine you and I could remember everything that was put in front of us. That would be a pretty powerful tool to reference everything that we see. Probably be pretty overwhelming. We might throw ourselves out a window, but the point is for an AI, it can easily look at this differential, and it gets really good at looking at the difference between a cat and a dog. In fact, it gets better at distinguishing a cat and dog than humans. And time again, when this test is done, it does this. Now, obviously, I don't know how much applicability there is between looking at the difference between a cat and a dog and looking at pixel by pixel pictures of this. But now let's switch that out and let's make that a cancerous tumor, right? Now it starts to find real differences between figuring out which kind of tumors are going to metastasize, what actual level of cancer they're at, or let's look at a stock or a bond. It starts looking at, is this a real stock with real growth potential based on the patterns that I've seen? Or we could look at other things like, is this a real good opportunity to invest in a mining company? Is this a sustainable resource? AI can start to look at some of these things and start to put out outputs that have a real data advantage for us to use when we're looking at complex problems. Now, what powers AI is actually the graphics processing unit. It comes back to video games, right? So parents, don't get angry at your kids for playing video games. They're probably building the next great technology. Now, when we look at computers, they would use a graphics processing system to run the graphics card. And AI is mainly a visual process. And again, I'm not going to belabor the technology, but when you look at a CPU is sort of like a Formula One car. It can do the most complex tasks and analysis imaginable, right? If we're going to go to Mars, it's going to be a CPU that figures out the physics trajectory for us to do that in a sustainable way. But with the GPU, you need to be able to have that lateral. It don't need to be quite as fast and complex, but you need breadth, that lateral visual process for the AI to really figure out its pattern and sequencing. So what's happened, and NVIDIA took a leadership role about 10 years ago, they recognized that their GPUs were ideal with the processing power for AI development. Now, if you're using AI development, you're using GPUs. So again, we talk about the picks and shovels. If you're in AI development, well, you need a GPU to either be used for the AI processing or use it to use AI in whatever systems you're using. So we're selling a lot of these GPUs now for AI development. And we see that there's Tesla on that GPU there. Move to the next slide. And the reason there's Tesla there is because in the self-driving cars, there's a GPU chip in a lot of those self-driving cars.
So am I correct in assuming that, the makers of these GPU units are sort of the builders of the infrastructure that we talked about earlier?
Exactly. And they all fit into this idea of this ETF we have, which has a lot of these kind of building components, right? And that's what we're talking about here. And NVIDIA is one of the larger holdings there, and I'll hit that in the next spot. But we have an ETF that basically aggregates all of the top 30 robotics, artificial intelligence, and AI companies in one index, and these are dispersed globally, and allows you to in one shot hold these largest companies, which are market cap weighted, we cap it at 8%, and gives you this global exposure to these companies that are really building Industry 4.0.
Great, and so on this slide are the details for this ETF we're offering, RBOT, RBOT, and for a very low fee of 68 basis points, you're able to have a one-stop shop to all these global investments that Mark has been talking about that are helping to expand. And these are the types of companies that are helping those FANG companies continue to grow.
Right, and I think, and you hit on this earlier, Jeff, like the reason you do an ETF here is a lot of these companies are in Japan and Taiwan and Korea. And, in trying to aggregate that yourself as an investor, it can get very costly very quickly. So having a one-stop thematic solution allows you to continue to have your technology exposure, probably to the NASDAQ or maybe your basket of FANG stocks. But now you have this real sector exposure to RAII where using this ETF.
Correct. Very hard to buy those individual names, so buying RBOT on the KZ exchange is a much easier way.
And we changed the investment objective. It's important to note that in July for this, only in that we changed the underlying index. So we initially launched this product as a ticker symbol called ROBO. This is the same ETF as ROBO in Canada. We now follow the Index Global Robotics and Artificial Intelligence Index, which is followed by the BOTS ETF, BOTZ. That's the largest artificial intelligence ETF and robotics ETF in the world. Now, really what I just need to highlight here is it's a very similar kind of sector exposure. However, we've now decided to have our exposure really more concentrated in those global leaders. Again, the Cisco systems of this Industry 4.0. And by doing that, we think there's performance benefits and liquidity benefits, I think, that flow through the ETF, and we were even able to reduce the management fee as a result of that.
Correct.
Now, if we look at some of the big holdings, again, I mentioned NVIDIA. Now, what I really like to mention with NVIDIA is I love the self-driving car example, because we can have a long debate about who's going to win the self-driving car. Is it going to be Google? Is it going to be Volkswagen? Even GM apparently is doing some pretty cool things there. But I would argue, if I really want to win the AI-enhanced vehicle race, I probably want to be investing in NVIDIA, because every single one of those four car manufacturers all use their GPU chips. Right? It's in everything. It's like Frank's Red Hot. And if we look at K-ON's Technologies, we also see here this is a sensor builder, and it's a huge company. Again, what we're doing with this index is we're focusing on companies that have real businesses with real revenue growth, right? This isn't pie in the sky. Very different from the internet era where, these companies had no earnings, just a lot of potential. These companies have potential, but they also have existing earnings. This is a $65.8 billion company, and all it does is make sensors. But if I need sensors, those again are my eyes and ears for Industry 4.0. And again, just using self-driving cars as an example, well, what's the real big difference between a Google Waymo car or an Uber self-driving car and what I'm currently driving on the road? Well, maybe I'm not driving a battery-powered car, but really the big difference is those sensors and GPUs. That's what it is. It's a car, but I'm going to enhance it with sensors and GPUs. And that's similar sort of disruption in most industries, right? Adding these things to make whatever they're doing smarter and more efficient. And then, of course, on this one here, this is actually the largest stock in the index, which is Intuitive Surgical, and very profound impact here in that, we see a surgery system that can do microsurgery and bloodless surgery. So things like prostate removal surgery, 90% of the surgeries being done in the United States for prostate removal are using this system. Now, it's expensive. It's about $2 million a year, about $100,000 a year maintenance. But it does that, right? It allows you to do a lot more dangerous, complex surgeries, but it also improves the lifespan of surgeons. We know we have a gray-haired surgeon there. And with someone like a surgeon, a surgeon's knowledge level is irreplaceable. They're not going to be replaced by AI anytime soon because they have decades of experience in looking at complex operating room scenarios. What ends up happening, though, is they end up, it's a very physical job. They end up having a limitation to what they can do because they get things like arthritis, aging. Well, this system actually prolongs the life of surgeons as well. So we're seeing a lot more of these kind of robots being put into hospitals, not so much in Canada, certainly in the private system in the US, although we're seeing a lot more Canadian foundations, hospital foundations kind of move forward and try to push that forward. If we look here, we're looking at robotics. The really big thing about robotics, and I think, is that if you're looking at e-commerce in particular, things that you don't think about, like sorting boxes, like that's a really big job that needs to be done. A lot of these robots, they have a challenge actually every year called the Moto Man Challenge, where they actually try to find robots to do the best job of sorting boxes. Now, that sounds very pedantic, but remember, that's a huge deal if I'm doing a shipping and receiving company. On slide 23, we have Daifuku. This company is kind of boring in that all it does is make conveyor belt systems with sensors. But if you think again, if I'm automating a factory, I need those conveyor belts for security at airport terminals. So these are the kind of companies that are in there. And I'm just going to flip forward to slide 25, and you can see these 10 companies here that are all part of this particular project.
Right, and on that note, I would note that a lot of those top 10 companies are international holdings. Again, hard to buy directly yourself, and obviously this is the opportunity to have all of these holdings in one solution in our RBOT ETF. And a lot of those companies are real companies, large companies with large market capitalization and real revenue and profitability. So you're not buying little science projects per se.
So then if we look at, where the index performance is when we look at something like this, we can see, that, the BOTS index has really lagged NASDAQ this year. It killed it last year, but it's really lagged it this year. And I don't think that's something to shy away from. There's a number of really key reasons why. We're about -3% when I looked last on this index, and the NASDAQ is up about 15%. So that's a huge variance. But the thing is, as we highlighted earlier, you probably have exposure to the NASDAQ and certainly the big narrow breadth of leadership on the NASDAQ. What you don't have is again, the companies in the robotics. And I think, I wanted to look more of a deep dive working with one of our analysts here as, what was happening with these companies? Why are they being discounted versus the broader tech sector? And what seems like what's happened is because a lot of these companies are in Japan and Asia, there's been a regional discount relative to U.S. companies, a lot of trade concerns. The trade concerns have also had people worried about orders for robots. But if we move to the next slide, we can see that, this really hasn't impacted earnings. So you've got a very unique opportunity here to look at, holding this product in terms of earnings growth. The PE ratio the average PE ratio going forward is about 22.8%. 22.8 on the BOTS index. Now that's high, but that's supported by an earnings growth of 58.68. Now, if I compare that to the NASDAQ, you're sort of in the similar sort of range. The NASDAQ's looking at about a 20% annualized one-year earnings per share growth. So these companies continue to grow their earnings, which really supports those valuations. And I think you're being given a gift right now in terms of the relative value versus earnings versus the NASDAQ, which makes this kind of a really interesting entry point where these macroeconomic situations have sort of beaten down some of these stocks, but they haven't dropped off at all from a revenue or earnings perspective. So, a nice entry point potentially right now to look at these stocks relative to technology stocks.
So yeah, that providing a little bit of a buying opportunity right now. Again, you touched on the geographical weight and maybe some of the trade rhetoric going on right now has caused some of those geographic areas to sell off a little bit.
Right.
And I think they've actually bounced back a little bit in the last couple of days since there's been some resolution at least being worked on. And again, as Mark said, you're getting a similar valuations to the NASDAQ, but much greater earnings growth. And again, a lot of these companies are the ones that are feeding those NASDAQ companies and continuing to help them grow as well. So as people look to diversify away from those traditional NASDAQ stocks, these stocks look very, very attractive in terms of long-term growth.
And all great points, Jeff. I think, that's why we're talking about this right now. And remember, we're not talking, I know I'm talking short term here, but I'm also highlighting that, as a long-term trend, there's something really, we think here in terms of looking at, an era of disruption that could be 2-3 decades in the making. So, over time, we likely see this business grow. And then, of course, short term, because we're all investors, that opportunity presents itself.
Right. So a little bit of a set it and forget it by looking to invest in this now and then hold it for quite some time.
Right. We can't technically go out and say that, but if you look at look at the fundamentals, it certainly suggests that there's an interesting entry point. So some key reasons to look at this strategy. Obviously, long-term growth opportunity. The steam engine took 100 years to catch on, and the internet took 20 years to really hit to the power users. We are looking at this again as another multi-decade opportunity. Diversification, little overlap with holdings and major stock indices. It's currency hedge, and this is really important for all of our people on the call here. Obviously, BOTS index exists in the U.S., but if you're using Canadian dollar account, we hedge out the U.S. dollar exposure, which is a key source of volatility when you're investing in foreign equities and only one Canadian holding in this particular strategy, which is Maxar Technologies. So, you are taking on that currency risk, and we're hedging out that main source of currency risk. And then there's takeover premiums. You have to imagine at some point that as this gets bigger, similar to the internet, similar to other large technologies, you start to see mega mergers and other takeouts occur. And we think, some of these stocks will start to come into play. Anyways, I think, that's a great place for us to finish off there.
Okay.
Yeah.
Thank you, Mark, for that. We reviewed RBOT quite extensively there, the opportunity of why you would consider looking to invest in this space and the how via our ETF. In addition to RBOT, we do have a blockchain ETF, investing in a lot of the companies that are building out the infrastructure of the blockchain ecosystem. And we also have Mind, which is we don't just talk about it, we actually implement it, where Mind is an ETF where we have a learning computer deciding on which global equity ETFs to invest in. So if you do want more information on those, please reach out to us at info@horizonsetfs.com. But again, those product sheets are available in the upper right-hand corner of your screen, and of course on our website. So what we're going to do now is we're going to open it up to some questions. So thank you, Mark, for your presentation. That was excellent. As a reminder, you can still submit questions through the question pane if you're interested in hearing some more feedback. But I'll start with some of the ones we have already. And the first one, excellent question. The challenge I have using niche ETFs is how thinly traded they are. if my platform is correct, it's not showing much volume. So does this pose a challenge to someone who needs to buy or sell a large position?
Take this one, Jeff.
Sure. Yes. First of all, the volume of an ETF does not equate liquidity. So if it isn't trading much, that does not mean there isn't liquidity. The liquidity is based on the liquidity of the underlying stock holdings. And we do have a piece on our website titled Volume versus Liquidity explaining this. So there is a lot of liquidity in the underlying names of this. So our market makers, our designated brokers, or the people helping facilitate the buying and selling of these ETFs are able to create liquidity very quickly and be able to provide that liquidity for anyone looking to sell. But on that note, RBOT itself is trading anywhere, and actually our website page will show you an average daily volume, and that's probably more accurate than the platform, because the platform, there's a lot of different platforms. So what we do is aggregate that up and show you an average daily volume in that ETF, but that would be anywhere between sort of 5,000 and 20,000 units every day in that range. So there is quite a lot of volume in RBOT itself, but again, the liquidity is based on the underlying holdings. So there is plenty of liquidity in terms of buying and selling this ETF.
I mean, if you go on your brokerage account and you look at your level 2 quotes, or just look at the bid-ask spread, you'll see that it's fairly reasonable. And I mean, the counterpart ETF in the United States, which is BOTS, trades, millions of units a day.
Correct.
So it's very easy to execute on these companies to build new ETF units. I mean, that's one of the reasons we built this strategy is for liquidity purposes. So, the only challenge from a liquidity standpoint is some of these Japanese, Asian names. But again, we're still dealing with large companies.
Mm-hmm.
And so through the course of the next 24 hours, we're able to build and bring in all that inventory, at a much lower cost than you would be able to do individually. Will this be a little bit more expensive from an execution standpoint than a Canadian equity ETF? Yes, but I think you'll be surprised not much, probably in the 2 to 3 cent range, right? As opposed to 1 cent. And I think, comparing that to the long-term benefits, it's probably a good trade-off.
Right, and we are obligated to keep that bid-ask spread as close to the net asset value as possible. And you'll be able to see that, as Mark said, on your quotes. And the next question was, what's the average cost of the holdings in this index? It's a hot industry, so I just want to know if I'm overpaying for the companies by buying the index. Great question. I think we did address that in one of the last slides by showing that the valuations are very similar to the traditional NASDAQ valuations, but they're growing they're growing at a higher rate. And we've also shown you how they've actually sold off a little bit in the last 6 months or so, and giving you the reason that we suspect being a little bit more geographic and trade war rhetoric, providing us that opportunity. Do you want to address that a little bit more?
Yeah, I think it's a very good question. I mean, relative to the global stock market, this is a little bit more expensive. What supports it is the earnings. So the earnings growth is what is driving this industry going forward, and obviously the long-term potential. But it is a growth sector, so you need to be ready for there to be periods of volatility, like we saw this year. At one point, it was down 8%. And that's not too dissimilar to other emerging industries. The only big difference between this and where I think that the PE gets warranted is, again, because there is the earnings growth. So when we look at other emerging sectors that are popular right now, like blockchain, marijuana, we're looking at sectors where there really isn't the earnings there. People are looking at the potential, and we could argue all day about what that potential is. With this business, this earnings are real. So I think that there's a lot of support already in the cash and the balance sheets of these companies to support the PE. Mm-hmm. And when I look at the relative PE to the NASDAQ, it does seem to be attractive. I mean, whether time will bear that out. But again, this is not something you're going to have 100% of your portfolio in, but it's a very important, probably, diversifier to your existing technology exposure.
Great. And another great question, will there be a more in-depth webinar on BKCH, our blockchain ETF, and MIND, our artificially intelligence managed ETF? And yes, that is something we would like to do, and with interest such as you're expressing, something like that could come out quite soon. It's a lot to cover in an hour, and we want to be cognizant of people's time tuning into a webinar. So we believed RBOT was the best opportunity to address today. But again, we'd love to provide you more information in the meantime, and then look to do a webinar more on blockchain in mind.
And I think it's important to highlight, Jeff, I mean, with the setup for those two ETFs is the same, right? These are still part of Industry 4.0. So PKCH is our blockchain ETF. Again, we're looking at the picks and shovel companies building semiconductors, using storage, building all of the hardware and infrastructure for that, because that's the really interesting part, right? We don't actually know if any companies that are purely focused on blockchain will survive, but we do know that companies that want to invest in blockchain or build blockchain, like big Canadian banks, RBC and BMO, for example, spending millions of dollars in that area, they'll be buying all of this infrastructure again to build that. And then Mind, of course, is a newer ETF from that we launched last November, where it uses an AI system. We live and breathe this at our firm. We actually have an ETF that's run by an artificial intelligence system. And again, it uses the exact technology I went over that played the Atari system, where it goes back and looks at stock market and then looks at all the market data from the last 11 years and any new data on a daily basis and starts to find patterns where it can try to outperform the global stock market. I think we will revisit those two particular areas as we get closer to a one-year number.
Okay, thank you, Mark. So we're going to end at this point. And if we didn't get to your question, we'll do our best to reach out to you and help you help answer any of the remaining questions that we didn't get a chance to get to, as we do want to end within the hour time period. So thanks again, Mark, for presenting on investing in disruption today. I think you made a great case of why one might consider looking at this space, and we're providing an excellent solution to help one do so. So once everyone leaves today's webinar, you'll receive a survey on the presentation. We'd appreciate any type of feedback. If you could complete that and provide your feedback, that would be greatly appreciated. You'll also receive a follow-up email in the next couple of days with a replay to this webinar. So if anyone wasn't able to attend, or if someone had to get off a little bit early, you will have a webinar within a few days, a replay of this webinar in a few days period. So on behalf of Horizons ETFs, I really would again like to thank everyone's attendance. Thank Mark for running us through that presentation. And just a reminder that we are social, so you can check us out on Facebook, Instagram, LinkedIn, etc. So and of course the traditional method of our website or emailing us at info@horizons.com, horizonsetfs.com. So I want to thank everyone again, and have a great rest of your day. Thank you.